Hello and welcome to Outlook Money's Investment Made Easy podcast series. This episode is led by ICICI Prudential Asset Management Company Limited. I am Versha Jain from Outlook Money and your host for this session. Welcome to another episode in our series where we delve into the complex world of finance and bring insights to deepen your financial understanding and enhance your overall financial well being. Brought to you in association with ICICI Prudential Asset Management Company Limited. In this episode today, we will discuss the new fund offer, the NFO of ICICI Prudential Nifty Metal ETF. This NFO will track the Nifty Metal Index, which comprises 15 stocks listed on the NSE. It aims to replicate the underlying index and provide return before expenses that correspond to the total return of the index. The Nifty Metal Index includes companies from the metal sector like copper, steel, and aluminum, as well as mining companies, and no single company in the index has more than 33% weightage. As metal is an integral component of infrastructure and economic development, to discuss how good the metal sector is to take exposure at this time, what is the investment strategy of this fund, who should invest in it, and much more. We have with us Mr. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC. Welcome, Mr. Haria, to have you back for this episode.
Thanks, Versha, and a big hello to all your listeners. Thank you.
So let's start the session now. Mr. Haria, to begin with, please give an overview of the Nifty Metal ETF and its investment strategy for the benefit of our listeners.
So it is have been our endeavor at ICICI Prudential Mutual Fund to provide all the potential avenues to investors, both on the active side and passive side in the index funds and ETFs. As part of our bouquet of ETFs, on the market cap side, we already have large, mid, small. On the smart beta side, we have a lot of options in low vol, alpha low vol, quality, value. And on the sectoral thematic side also, we've built a bouquet for investors to benefit from the various sectors in India, which are actually doing well. So right from auto, FMCG, IT, private bank, so on and so forth. Recently, we launched the oil and gas ETF, I think a couple of weeks back. And in that connection or in that chronology, we are happy to bring one of the most important sectors for building India's infrastructure, building India's growth, aiding our growth towards becoming a manufacturing hub, and also supporting the various demands of the consumer in India in terms of housing and infrastructure. And that is the metals sector. So the ICICI Prudential Nifty Metals ETF is one of the ways in which investors can participate in the companies which are in the field of metals. As we all know, India is already the second largest in steel production, fourth largest in iron ore, second largest in aluminium. We are blessed with mineral reserves or natural reserves. We have enough iron ore, we have enough aluminium also. And of course, in terms of the processing capacities, we have large companies doing so. Many of these companies are also having international presence. And so we felt that this is a sector which, in terms of its weightage in the broader market index, may be small. But as far as India's growth story is concerned, it is an important sector. And hence, we wanted to bring an ETF which allows investors who are looking at long-term growth potential for the metals sector. And that's why we are very happy to launch the ICICI Prudential Nifty Metals ETF.
All right. And how does a metal ETF that invests in copper, steel, aluminum, like you said, compare with precious metals ETFs like gold and silver? Should the choice be between precious metal versus base metals for investors?
So, just to make it the distinction clear for investors, when you invest in a gold ETF or a gold fund of fund, the backing or the support in the physical form is of gold stored in volts. So also for silver, when you invest in a silver ETF or a silver fund of fund, the backing in the volts is of silver. In the case of the Nifty Metals ETF, the index is made up of 15 constituents of underlying companies. So this is an equity ETF where the underlying companies are basically engaged in the business of production or exploration of metals. which is where this is being an ETF, which is investing in companies. It's an equity ETF giving you exposure to the metals sector. It is not essentially an ETF which is investing in underlying metals such as zinc, aluminum, copper. That is not allowed in India as of now, but it is investing in companies. If you look at the top companies which are part of the index, be it Tata Steel, JSW Steel, Hindustan Zinc, etc., they are basically engaged in the business of mining of NMDC, NALCO for that matter, mining of minerals. And obviously, some of them are converters or producers of steel, etc., by converting those minerals. And that is where this is essentially an ETF, which is investing in the companies which are engaged in the metal sector and not investing in the metals or underlying minerals themselves. So that's a distinction which investors should know. It's an equity ETF, not a commodity ETF.
Thanks for bringing clarity to this precious versus base metal idea. So this ETF is investing in companies rather than in the commodities themselves. Now, please throw some light on the supply chain for metals and how does it operate globally as well as in India?
Metals are globally linked, and as you mentioned, the supply chain is also globally linked. So, for example, iron ore large production happens in the countries outside of India as well as in India. And if India needs more iron ore, we need to import it from countries as far off, maybe from Australia or Indonesia, etc., wherever it is produced. There are certain copper which comes from, say, African countries. So effectively, if you look at metals, a large part of the supply chain is globally interlinked. And also, prices of metals are determined by global supply chain or global exchanges and global prices. So India does not dictate the prices of the underlying commodities. These commodities being global commodities, which on the ferrous side, of course, is iron ore and steel. On the non-ferrous side is aluminum, copper, zinc. These are essentially global commodities where the pricing happens globally, and India is a price taker. India does not necessarily impact the pricing globally because India is a relatively smaller player in the global production, while in certain places we are very large, but still, it being a global supply chain, we cannot influence beyond a point the prices of the underlying metals. So, yes, global supply chain matters, and hence, during COVID, we saw when supply chains went out of whack, the prices of these commodities went up meaningfully because demand was there while the supply was constrained by supply chains. So supply chains are very important. Supply chain essentially is the movement of the raw material from the producing country to the country which is consuming the raw material in terms of conversion. And that is an important aspect. But from an investor standpoint, what is important is from an India context, what is the growth potential for these commodities? And if we look at a simple commodity like steel, from
Hmm.
130 million tons to maybe 150 million tons in the next 2 years, we were consuming about 60, 70,000 tons of steel, metric tons of steel, which is now going to 130 million tons. So effectively, we've doubled our steel consumption in the last 7 to 8 years because more roads, more ports, more highways, more dams, more construction activity for residential buildings is happening. And steel is one of the major inputs there. Similarly, aluminum, copper, also copper, because electrification is increasing across the board. Copper is one of the most important elements of electrification, and aluminum in terms of the diversified uses that it has, along with zinc. In all aspects, if our economy is growing and our GDP is growing, the utilization of the commodities or the demand for commodities is increasing, and which is helping the Indian companies. Also, Indian government over the last many years, say 5 to 7 years, has come up with progressive regulations which are helping the metal sector in India. So FDI up to 100% was allowed in 2019 in basically the metals. There was a production linked incentive scheme for specialty steel, which was launched as part of the drive to improve India's specialty steel production. The customs duty for critical raw materials has been reduced over time, and some of the domestic companies have been also, let's say, encouraged to do more of specialized mineral mining in India. So those rare earth minerals, which otherwise China has a monopoly on, more or less, and some of the African countries, India also has some deposits of rare earth minerals which have not been mined so far. So the Mines and Minerals Act of 2021 is giving a push for these rare earth minerals, and some of the companies as part of the index are involved in the rare earth minerals exploration as well. So eventually, as we move from a $4 trillion economy to an $8 trillion economy, metals is going to be at the core of the growth of the economy. And hence, we do believe while global supply chain is difficult to predict what will happen when we have so many wars, so many complications around global supply chain, the demand for India for metals is going to remain strong. And that's where, in the long run, we are positive on the metal sector, and investors can look at this as an additional tool to increase exposure to metals, which otherwise do not necessarily form a part of investors' portfolio in a big way because it's a very small part of the index.
All right. Thanks for explaining it all. Now tell us what are the key factors that can influence? You have already mentioned few, but if there is any other key factors per se that can influence the metal sector's performance in India?
Obviously, the key factors are demand growth, which is strong. Second is the government policies, which are supportive of the sector right now, wherein infrastructure spending at 11.5 lakh crores from the government budget is at an all-time high. There is also a very strong demand for residential units as India moves towards a higher middle class or a larger middle class with more demand for residential units. Also, the urbanization in India means that you'll need more and more metals because urbanization requires a lot of metals for everything that a city needs to be built with. And so, if we look at the overall scenario of demand in India, much like we've seen it happen in the developed countries, wherein the time that they grow, the demand for metals is meaningfully large. And India should also go that path. So the factors are clearly the domestic demand being strong because our GDP growth is strong, our demand is strong, government's focus on infrastructure is meaningfully large, and we have many large companies within the metals sector which can be invested upon and which are doing good things. And courtesy the last 4 to 5 years of significant growth in demand, their balance sheets are also strong. The balance sheets of the companies are strong. We've seen strong consolidation in the sector, wherein many of the smaller companies within the metal sector, which were not doing well, have been basically bought over by the larger companies. So the consolidation in the sector has meant the larger companies with stronger balance sheets are now able to probably take advantage of the demand growth, while also that is reflecting in their market capitalization. So I think it's a combination of factors which is making the sector look good right now. While it is a high beta sector and it moves significantly up and down with the markets in terms of its direction, in the long run, we believe these companies have a good scope to be adding to the client's portfolio if the buying price or the buying timing is something which they, over a period of time, accumulate the units.
All right. It's clear that there are so many factors at play to determine the direction of the metal sector. As you said, the government policy, the huge demand, residential demand, as well as urbanization. Now, moving on to the next question. What are the main risks associated with investing in a Nifty Metal ETF? What percentage should one allocate to sector-specific fund? And so basically, what are the risks and what can investors do to reduce it?
So as you had mentioned, commodities are globally linked. If
Mm.
there is a global shock or a global worries which come up, and we are seeing some of it working around right now, which leads to a significant destruction of economic activity globally and lower demand for commodities, that impacts the prices of commodities in India as well as the profitability of the metal companies which are part of the India listed universe, which in turn will negatively impact the Nifty Metals ETF. So the risk is that if globally the demand comes down and the prices come down, which has already happened to a very large extent. For example, aluminum in the global markets, which had gone above $3,000 2 years back, is already corrected and is now at $2,200. So also steel the price correction has happened globally as China demand has come down meaningfully. And we've seen correction happening in copper as well recently, where it's corrected by 15 to 20% in the last 3 months or 4 months or so. And so the slowdown in the global GDP growth does impact metal companies in terms of the prices of global metals, which in turn will affect the profitability of metals. So whenever there's a global slowdown, if the metal companies get impacted, that would in fact be a good time for investors to take the benefit of any sharp fall to add to their portfolio. But yes, when the fall is happening, the global GDP fall is happening or the GDP contraction is happening, that's the biggest risk to metals. Other than that, of course, generally the metal companies, if the balance sheets are leveraged or the margins are thin, that's always been a risk traditionally. But many of these companies in India on the listed space have kind of strengthened their balance sheet meaningfully over the last 5 to 7 years of boom that has happened, and hence that risk is much smaller. I think the global risk is much larger. How do investors mitigate this risk? At any point of time, as we've always been mentioning, we need not have more than, let's say, 20% in thematic funds. And within that 20%, a single theme should ideally not be more than 10%. So if you look at your overall portfolio asset allocation, I think 40% to 50% should be in the balanced advantage fund, multi-asset fund, dynamic asset fund category. There should be about 15 to 20% in gold, silver, which acts as a buffer. The rest 15-20% can be in diversified flexi cap funds or multi-cap funds, which gives you a flavor of the wider market. And of course, then the balance remaining 15 to 20%, you can think of themes which generally are more volatile, and themes can have ups and downs which are sharp. But themes also allow you to basically get that alpha kicker in your portfolio or a higher return potential if you enter the theme at the right time. So not more than 20% of your portfolio should be in themes or high beta. And if you look at from a single fund or single ETF or a single theme perspective, ideally not more than 10% of your portfolio should be in the theme. And that 10% also you should try and accumulate over a period of time and not in a single go. When the general rule is that if a specific theme or a sector or a space of market is under-owned, undervalued, and has underperformed, that's the time when you basically build a very big position in them. I repeat, when a theme has underperformed, undervalued, and is underowned means not many investors are owning it at this point of time, or it has been neglected by investors. Underperforming means it has not performed for the last 3, 4, 5, 6 years versus the rest of the market. That is the time when you generally look at investing in a big way. So spread out your investments. That will reduce your risk in a single theme and not more than say 10% in a single theme. That's one of the risk management tools which you should always have. And having a balanced portfolio, which I've just mentioned, how to create a balanced portfolio is also extremely important.
Wonderfully explained diversification strategy. And as you said, to get the alpha kicker to the portfolio, thematic fund can do that work for you, for the investors. As this scheme is for the long term. So in the wake of budget and the changed rule for capital gains, taxation can't be ignored. So please do tell us about the tax implication also of this of investing in this ETF.
So if we look at the budget has made it simpler in terms of comparative for all asset classes in which generally investors invest, especially for equity ETFs, where the Nifty Metals ETF would fall into. It's been made very simple. For more than 12 months, if you own the Nifty Metals ETF, whatever capital gain you have, you'll be taxed at 12.5% plus surcharge. If it is less, without indexation, of course, and if it is less than, there is no concept of indexation now anywhere. So as things stand right now, the concept of indexation has gone away from across all asset classes. It's simple, long-term and short-term. If any listed investments you are investing in, then in that listed investment, you basically have the advantage of 12.5% long-term capital gains tax, which is essentially what the Nifty Metals ETF would also get the benefit of. And less than 12 months, you will be taxed at 20%. So short-term capital gains tax has been increased from 15 to 20%, and long-term capital gains tax has been increased from 10 to 12.5%. These benefits, of course, are for those funds which do not have debt more than 65%. So any mutual fund which has debt more than 65%, there is no benefit of any capital gains taxation. It will be considered at marginal rate. But other than those funds where more than 65% is in debt, so any ETF, gold ETF, silver ETF, your metals ETF, oil and gas ETF, any ETF which you have, if you have for more than 12 months, your long-term capital gains is 12.5%. Equity ETFs for less than 12 months if you own, your short-term capital gains is 20%. So that will be the tax applicability for the metals ETF as well. More than 12 months if you own, you and capital gains is there, you'll pay 12.5. Less than 12 months, you'll pay 20% short-term capital gains on the metals ETF.
So as this is an equity investment, the capital gain will be determined based on the duration. Investors keep the money in this. Up to 12 months, it is 20%, and after 12 months, if they sell the fund, it will be 12.5% of taxation under capital gain. So now finally, this is my last question. What is the advantage of investing in a sector-specific ETF compared to a broader market ETF? As sectoral investment is risky, so who should invest in these?
So generally, we've seen more evolved investors who understands the risks and rewards of the market, probably diversify away from diversified mutual funds or diversified ETFs, broad market ETFs, towards sectoral ETFs, because sectors and themes can actually add a lot of value to your portfolio in terms of the alpha kicker. Just as an example, if you look at, let's say, how the pharma ETFs worked between 2020 to 2024, they can add a lot of value. Between 2015 and 2020, pharma as a sector was not doing well. If you accumulated it over 2015 to 2020, the pharma ETFs did very well for you between 2020 to 2024. Similarly, auto as a sector between 2018 to 2021 didn't do well. If you accumulated auto between 2018 to 2021, you got a very big kicker relative to markets between 2021 to 2024. Many examples of the same entire PSU sector, for example, if you look at public sector banks or even public sector enterprises or PSUs in general, between 2013, 14 and 2021, the PSUs did not do well. And then last 3 years, we've seen PSUs do extremely well. So thematic investing is for those investors who are more aware, who are more knowledgeable in terms of how to diversify their portfolio into more risky areas while keeping the risk management in place, and those who understand which sector and which theme is going to work well. And generally, the rule of thumb, like I mentioned, is you make outsized returns when you invest in a specific theme or a specific investment wherein there is underperformance, under ownership, and undervaluation. Now, it's very difficult to find these three, but when you do find these three, the next 3, 4, 5 years, there is a time when the turnaround happens and you make big money. And that's where thematic investing is for those evolved investors who can understand, be patient, take pain for a longer period of time, and those who can take pain for the longer period of time can actually get the disproportionate benefit. It's not like if you're investing in a theme, within 12 months, you'll get immediate returns. Within 24 months, you'll get immediate return. It can take you pain. Markets can rise higher while the theme may not work. But when the theme or the sector works, it can give you disproportionate return. So I think the nuances of each sector and each theme have to be understood well before you invest in this particular product or any thematic fund for that matter, or sectoral fund. And that's where a slightly more evolved investor who's seen market cycles, who's been in the market for long, can probably add a lot of value to their portfolio by investing in the sectors and themes.
Thank you, Mr. Haria, for sharing your insights with us. As you said, underperformance, under ownership, and undervaluation. These are the three nuances for investors should consider before investing their money in any thematic fund. We trust our listeners have found this discussion engaging. It's important to note that the contents of the discussion should not be construed as an editorial recommendation from Outlook Money. And with this, today's episode of Investment Made Easy podcast comes to an end. to Outlook Money's podcast series to further explore investment topics. And don't forget to like, share, and subscribe to stay financially informed. We welcome your suggestions, feedback, and questions at letters@outlookmoney.com. Stay tuned for our next edition, and until then, stay informed and continue to follow Outlook Money, your go to personal finance magazine.